Who do you ask for property investment advice? Well, a better question is who could you ask? Why not ask Warren Buffett, probably the best investor in the world, about what to do today with regard to the Australian property market and maybe more specifically the Melbourne property market. That's what we're going to do in today's show when I chat with Brett Warren, National Director of Property at Metropole. Now, clearly Warren Buffett isn't going to be our guest today, but there's so much information about his philosophy that we're going to share that with you and see how it applies to the local property markets. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
If Warren Buffett, the Oracle of Omaha as they call him, were eyeing the Melbourne residential property market today, while many people would say, it's not a good time to get in. Look, the government's having troubles. The government's taxing investors. There's all these taxes. I think Warren Buffett would most likely see an opportunity where others people see uncertainty. Look, we know Warren Buffett's well known for some timeless investment principles, and I believe they're also going to be surprisingly applicable to the Melbourne real estate landscape. So to discuss this today, I'm looking forward to my chat with Brett Warren, National Director of Property at Metropole. Hi, Brett.
Hi, Michael. Good to be with you. And look, certainly getting that feeling myself, if I was listening to the media at the moment, I'd certainly be steering clear of Melbourne. They're creating a lot of fear. There's a lot of, hangover effects from COVID. There's some land tax implications, some government intervention and things like that as well with various things. So, yeah, certainly a time to be fearful, but maybe that does create opportunities. I know we're talking about Melbourne, but investing overall, and as we do take a long-term approach. So I think, Warren Buffett's principles of timeless, and I've learned a lot of those from yourself. So I'm really looking forward to unpacking some of these.
Well, you said fearful. That was a really good lead-in, because we know that one of Warren Buffett's great quotes is, be fearful when others are greedy and greedy when others are fearful. Now, we know that Warren Buffett invests in companies and in the stock market, not in real estate directly, but I think we could understand how his philosophies could guide us to making smart investment decisions. And as you say, we're talking about the Melbourne property market in particular, but let's also just widen it a bit, Brett, and see how we could relate these to the general market. So rule number one that he keeps quoting is, don't lose money. And then his rule number two is, read rule number one again. I guess it's simple but profound. He's saying protect your capital, Brett.
Yeah, look, I'm got a sporting background, Michael, so one of my favourite sayings, particularly at the moment, it's a similar saying, is the best form of offense at the moment and taking action at the moment, I actually think, is defense. All markets around the country, other than a couple, have kind of gone up in value. So, I think we're probably closer to a recovery or a recession in some kind of markets and some kind of locations. So it's very important to understand that. You could have bought anywhere 5 years ago, but moving forward, that's not going to be the case. So Melbourne hasn't done as well as other markets, and there's an opportunity there. It's softened. There's some areas for concern, but we see opportunity. I'm sure. Getting back to the point there, the rule, you're probably not going to fall far if there is some kind of downturn in Melbourne, are you?
I think that's right. Your downside is limited. I guess the goal isn't, though, to buy cheap properties because they're cheap, because, to be blunt, in many areas, property values are less than they were a year ago. Overall, because there isn't a Melbourne property market, the market's much the same as it was 12 months ago. It's still significantly higher than it was pre-COVID. But the goal isn't, in my mind, to buy cheap properties, but to buy quality assets at prices that, as you say, have got a margin of safety, thereby minimising your risk and maximising the long-term rewards. I guess it's what we in our six-step approach say, buying below intrinsic value, because price is what you pay, but value is what you get. I actually think that's probably another one of Warren Buffett's sayings, Brett.
Yeah, definitely. And that's not buying below market value, is it, Michael? I mean, intrinsic value, a great example that we're seeing at the moment is the apartment market, where the market hasn't grown in value, but construction costs and those types of things have really skyrocketed. So all these new developers that need to get off the plan sales and things like that as well, the next round of apartments need to be 20 to 30% more expensive. So
Just to
we're
break
buying
even.
just to break even. So we're buying good apartments and good villas and places like that in Melbourne that are, I guess, below replacement cost because it's so much at the moment. So certainly that there are other markets, but Melbourne does start to tick a lot of these boxes when we start to talk about that. It does offer a lot more value in terms of what we're kind of looking at.
I guess it's where Perth was and maybe where Brisbane was 2-3 years ago, Brett.
Look, I'm seeing a lot of, and getting a lot of feedback about the Brisbane market. I remember 16, 17, 18 when Perth and Melbourne and Sydney were doing exceptionally well, but Brisbane wasn't doing anything. We weren't creating any jobs. There was nothing happening. But, Melbourne's an international city, Michael. It's not like we've lost mining or something's left town. All that'll come back. And I know we've spoken extensively about the population growth moving there in the next 5 to 10 years. And there's as we spoke about now, there's a huge undersupply of accommodation and properties coming on the market. So, certainly those fundamentals, and as we talk about, and Warren Buffett talks about, focusing on that medium to longer term, certainly looks like there's opportunity there.
Yeah, I guess in other words, there's prime opportunity to acquire quality assets that are temporarily undervalued, but that possess long-term growth fundamentals. And why? Because the market is going to get anyone who buys in will get a bit of a free kick as it picks up, and then it will revert to the mean. But I think we've got to be careful. The Melbourne property market's very fragmented. Like all the markets, not all properties are going to be what we call investment grade that outperform the market. But anyone we're speaking to, whether it's Andrew Wilson in my weekly chats, Stuart Weems in our podcast, Pete Wargent, in fact, most of the other big commentators all think Melbourne is on the brink of a turnaround, suggesting maybe the price people would pay today, if they buy using Warren Buffett's philosophy, is going to be a bargain in a year or two's time.
Well, quite potentially, and I dare say in 5 years' time it'll even look better, won't it? Most certainly. Look, number two, I guess you're talking about markets within markets. I think one of Warren Buffett's second rule is position still reigns supreme. So getting that location, as you said, markets within markets and areas within areas, that location is going to be more critical and more important than ever, isn't it?
Well, he talks about buying quality assets, and again, he's talking shares or companies, but I also like that other quote that we actually haven't used for a while. When the tide goes out, you see who's swimming naked, because in a rising market, everyone looks pretty good, and there's a whole range of new buyers agents and others who say, I've got all the data, I know where to look. But in property terms, this means that when the market softens, properties in desirable locations tend to maintain their value and bounce back quicker, Brett.
Michael, do you think we'll be using that a bit more in the next 5 years? There's a lot of markets, regional markets that have underperformed, that haven't really done as well. And I suspect that we'll probably be having that conversation more and more. And unfortunately, a lot of people will get caught out. So now's an opportunity to adjust that. And I guess get back to those really areas with proven track records, with high demand from big employment hubs, low supply of land. We talked a little bit about rising incomes and the ability to ride those periods out with higher savings rates, paying more for property. You can't beat those 20-minute neighbourhoods. The next generation don't want to keep moving further and further out. It's probably more the investors that are buying on the outskirts. Those home buyers are moving further in and getting into that kind of 20-minute neighbourhood we spoke about. So I often hear Warren Buffett also talk about putting a moat or around your investments as well. So that's potentially a form of protection and getting that right as well.
Yeah, he says put a moat around it so others can't get at you. But I think what you were saying is about the neighbourhoods. I think it's important when interest rates fall, and they will, whether it's at the end of this year, whether it's early next year. Interestingly, National Australia Bank has now brought forward its forecast that the first fall in interest rate will be in February 2025. It used to be May. So Commonwealth Bank suggests, and the money market suggesting, rates are likely to fall, the first fall this year. Our other three big banks suggest February next year. And National Australia Bank thought that the official rate's going to drop to about 3.1%. We don't know exactly what that Goldilocks figure, where the interest rate's low enough to stimulate the economy and make it comfortable, but not too low to make it cause inflation again, and not too high to dampen demand. Anyway, so interest rates aren't going to fall way back to where they were during the pandemic, but National Australia Bank believes there's going to be, and all the banks, there's going to be 5 or 6 rate cuts over the year or two. When they occur, in my mind, property values are going to increase. And I remember at our recent masterclass, Brett, you showed some Ray White data that showed that within the first month after if there weren't interest rate changes for 6 months, and Ray White went back for the 5 cycles, saw that Melbourne and Sydney were the first ones to benefit from it, but it was more the higher end where people have got multiple streams of income, because I still believe for a while there's going to be affordability issues, cash flow issues, housing budget issues in families that don't have as big an income, but where people have got high incomes and multiple streams of income, whether it's shares, dividends, business dividends, they're the ones who are going to be able to borrow again. So I'd be looking at buying in those gentrifying suburbs where those people are going to move in. So even when interest rates do fall and the cycle does move on, in general, that has always started at the top end of the market, like it did in 2023, and then slowly trickled down to more affordable locations. Yep. Any other great thoughts of Warren Buffett's that come to mind?
Yeah, look, I guess it can be tricky to get all these things right, Michael, can't it? I mean, from one year to the other, interest rates change and the market changes and what happens here and what happens there. So one of, I guess, Warren Buffett's best approaches is that long-term durability and focusing on the longer term, because it takes out a lot of the short-term issues. But maybe before I get you to get into this a little bit more, Michael, maybe you could give me your definition of short, medium, and longer term, because I know the next generation, their definition of short term is probably a month, and long term is probably 3 years. So what's your definition?
That's a good point, and you are right, because in the younger generations where everything is happening instantly, that could be different. So yes, you're right. Warren Buffett clearly says his favourite holding term is forever. If he says something along the lines of, if the stock market would close for 10 years, would you be happy holding that share, that stock that you couldn't sell? So we often say that to develop financial freedom in property, you need probably 30 years. You may get away with 20 years. I know people don't like hearing that, but you need to build your asset base, and then you've got to slowly lower your loan to value ratio. So to me, long term is anything over 20 years, and more like 30 years. Medium term is 10, probably 15 to 20 years. And short term is anything less than 10 years. You've got to live through it and get through at least 1 or 2 cycles to recoup your initial costs, to get through the difficult times. Yet we find that the latest CoreLogic Pain and Gain report showed that people are selling up within 3 years. They've made mistakes. In fact, we know the statistics suggest 50% of those who get into property investment sell up in the first 5 years. Brett, they've made a mistake, and it's costly.
They have. And look, I guess that's disappointing, because the last newsletter I got told me I could retire in the next 3 or 4 years. So you talking about 20 or 30 years is disappointing, but that's the reality, isn't it? That's the reality of the situation.
It is, and some people don't want to hear that. No. We would get lots more, let's be blunt, we are directors and business partners of Metropole, and our job is to help clients safely grow intergenerational wealth above average rates, but safely, to be able to pass it on to future generations. And boy, we'd get more clients in if our emails and our newsletters said, come to us and before Christmas you'll double your money. And I'm seeing those emails as well. But we've been there for the long term. So first of all, we've got a huge database of clients to know what works. We've got all the data to know what works. But we also, you and I have been in the market for decades, which means we're realistic. We don't just look at what happened in the last little while. Wouldn't it be great if the double-digit growth Brisbane experienced, Perth experienced, Adelaide experienced happened every year? It doesn't. You've got to look what's happened over 40 years.
Absolutely. It would be absolutely amazing. But look, I guess the next one's a little bit controversial, because it's focusing on cash flow and yield and growth and things like that as well. And while that's, I guess, we do focus on longer term and capital growth, but it's all about getting into a position where you do have the cash flow and you do have that ability, you talk about a cash machine to kind of walk away. So Melbourne does offer that opportunity, right? Because rents are continuing to rise.
Yes.
Prices haven't risen yet. So the rental returns are actually reasonably strong. And we talk about getting investors back in the market, because they generally do chase yield.
Well, Warren Buffett is the cash flow king in some ways. He buys businesses that churn out cash flow. Residential real estate is a high growth, relatively low yield investment. Cash flow is important. So when clients come to Metropole, we put a strategic plan together that takes into account their income, their expenses, their future expenses. Maybe they're going to stop and have a baby. Maybe they're going to go overseas for a year or two. All those are factored in the very powerful software we use to help them plan to become the people they plan to become. And then we show them what they need. And one of the things that we can help clients with is to buy time, not just properties. In other words, if we can show them that they can hold this property, even if it's got a bit of negative cash flow, because we've also given them a cash flow buffer to see them through for 3 or 5 years, in which time the rent will go up, the mortgage rates will come down a bit, they'll have saved a bit more income. So cash flow will keep you in the game, but we always say it's capital growth that gets you out of the rat race. But it depends in what stage of your journey you're on, Brett. So beginners need to build an asset base first and then slowly lower their loan to value ratios. And then eventually, yes, you want cash flow.
Michael, that word buffer might be foreign to some people, but I think that kind of comes back to rule number one, right? Don't lose your capital, because, if you set yourself up and we do get these interest rate rises like we've had and people have had to sell, they haven't had a buffer in place, then they're kind of defeating the purpose. So I think having a buffer and having an overall plan is very, very important. And it also minimises the risks and maximises your returns. And I think I hear you always say, prepare for the worst and hope it never happens, rather than happening and wish you'd kind of prepared for it. So, that's another one.
That's a good point. But again, and I'm sorry to keep bringing it up, but that's the purpose of having a plan. It shows you what to do and what you shouldn't do, but it also tells you what you can realistically do with your income, because some people just don't realize that. So buying a property isn't a plan. Looking on the internet isn't research. It's all looking in the rear vision mirror. So first of all, we've got to use the information and the demographics to see what's ahead, but also to help people with their cash flow. And again, that's the concept of buying time. And so cash flow is important. So some people say, you just keep talking about capital growth. No, we recognize the importance of it. And some clients need a different blend. And so the locations we buy in or the sort of properties we help them buy will depend upon what sort of yields they require too. So there's not a one size fits all, is there?
No, well, not with us. With other people, maybe, but not with us.
Yeah.
Michael, rule number 5 of Warren Buffett's rules, I guess, is something we've kind of touched on, is ignoring those short-term market fluctuations. And I guess ignoring the short-term blips as well. Don't make long-term decisions based on the last 5 minutes of the nightly news type of thing.
That's a really good point. So he ignores the short-term market noise. And that was one of the comments I made a while ago, where he says just to pretend that the market closes for 10 years. There is another interesting story from his mate Graham, who basically talked about Mr. Market. Mr. Market was in the book, sorry, editor, I'm just going to cut that out. What was his partner's name? Do you remember? The book was about the Mr. Market. You quickly look it up. Benjamin Graham. I got it. Okay. Editor, we're back on track now. Interestingly, Benjamin Graham, Warren Buffett's one of Warren Buffett's friends, wrote in his book about Mr. Market. And Mr. Market would come each morning, and one day he'd be really excited and he'd be up and elated, and he'd buy shares. And the next morning he'd come back and he'd be all disappointed because of what was in the news and sell shares. And it's much the same in the property market, Brett. Today, investor sentiment very much is driven by the media and by social media, isn't it?
Look, it certainly is. And, I did a development workshop last week, Michael, and one of the indices that you can look at now is you can look at the property prices on a daily basis. And just like you would with shares, can you imagine how crazy you would go if you actually did do that, rather than just focusing on the longer term and getting that into the mind? And it is hard, though, Michael, isn't it? I mean, particularly at the moment, there's a lot of media attention, pushing people away from Melbourne and suggesting it's not a good idea. But I guess you've got to look longer term, focus on those longer term fundamentals, because in reality they don't change, and it takes out those shorter term market fluctuations and guessing on interest rates and inflation and things like that as well.
Well, it's interesting. A good friend, Andrew Wilson, has a daily index. that he keeps hidden and doesn't tell people for exactly the reason that you said, because his data changes daily depending upon sales, and he updates his information. I know because we're good friends and we speak to each other, but he stopped showing that to the public because it gives the wrong impression that you got an idea of what's going on. And even what's happening over the last month or two is not as relevant. While Melbourne's property market has been sluggish recently, history has shown that all property markets move in cycles. And looking back over the last 40 years, we've got, I think, 48 years of data, Melbourne's property market has outperformed all other capital cities. Fact is, all property downturns or sluggish times like this set the scene for the next upturn. And now, just like every upturn, I guess, sets the scene for the next flatter period. But I agree with you that investing now in the right sort of property at the right price could position you for much better appreciation as the market inevitably recovers, because that's what happens in the long term.
Most definitely. Number 6, Michael, don't try and time the market. I know we're talking about a specific market here, but in reality, it's time in the market that matters. And we've actually done research on this as well. So maybe you could explain a little bit about your thoughts on that.
Well, interestingly, our friend Stuart Weems, who's regularly on this podcast as well, did some very detailed study on this a couple of years ago when they talked about removing negative gearing, and he wanted to see, just changing one factor at a time, what was the most important factor with regard to long-term success. So he assumed you bought a property, you kept it for 20 years, you sold it and paid capital gains tax. What would happen if you timed the market and bought it 5% cheaper? What would happen if you timed the market badly and paid 10% more? What would happen if they removed negative gearing, if they changed capital gains tax laws, all the rest? Interestingly, his conclusion from that, Brett, was the most important factor was capital growth. In other words, the quality of your asset. And sure, timing the market will give you a one-off free kick, but over the medium to long term, it's irrelevant compared to 1% better capital growth by choosing the right asset in the right location. So I guess the message there is focusing on quality assets, but then holding them for the long term, because we know how compounding works. If you look over 15 years, the first 5 years it grows a bit, the next 5 years it grows even more, and the last 5 years you get more than 60% of the growth. Just like Warren Buffett, everyone keeps saying that he made most of his money after the age of 65. I guess that means there's still hope for me yet, Brett.
No, plenty of hope, Michael. And I guess the other thing it does, I believe, Michael, it actually takes the stress out of investing. I mean, we talk on a daily basis, but how often do we talk about our stress with regards to interest rates or what's happening with inflation? Or, we've set ourselves up. We understand that these kinds of things are going to happen. You often talk about, rather than forecasting, having these kinds of expectations. So maybe that's why you look so young, Michael, because you take out the stress of the day-to-day thoughts around interest rates and not making it work and holding properties and things like that as well, because you've got a plan in place. And that longer term really takes a lot of these things out of the equation, doesn't it?
That's right. So with regard to forecasting expectations, I know the Melbourne property market's going to pick up. I don't know exactly when that is going to be, so I have an expectation rather than the forecast. I know the whole market is going to improve for a while when interest rates go up, and then the cycle is going to move on and we're going to have another downturn. I don't know what that is, and that's very different when that's going to be. And that's very different from saying in June 2026 the market's going to turn. An expectation, I'm not copping out, but by having expectations that we're going to have another recession one day, that interest rates will drop and they'll go up again, that some of my investments will do better than others, makes me a more focused and more stable investor rather than being as concerned by the ups and downs, Brett.
Definitely. The last one, Michael, I think we can specifically apply this to the Melbourne market is rule number 7, invest with a level of safety and a margin of safety. And I know Warren Buffett does a lot of analysis on this, but I guess we've talked a little bit about a buffer, which is kind of superficial level of safety. But I guess digging in a little bit deeper than that, talk to me about your thoughts on the Melbourne market and why it's kind of got that level of safety involved.
Well, let's talk about the markets in general. So how you get a margin of safety is buying quality assets, we've said, that don't fluctuate in price as much, buying below intrinsic value, buying the sort of property that's going to be in continuous strong demand, particularly by owner-occupiers, because they're the ones that drive the markets. They're the ones that buy with their heart rather than their calculator. They're the ones that are always going to be there while investors create the booms and the downturns when sentiment plays up. So buying the sort of asset to which you can add some value by manufacturing capital growth, by buying an asset which has got a twist, something special about it, maybe a double garage rather than a single garage if it's an apartment, or a balcony, or a good courtyard if it's a villa unit or a townhouse. So by buying something unique, and interestingly, I just realised as I was doing that, that's part of the six-stranded strategic approach that our buyers agents use in finding a property. Hey, I didn't even mention price, but it is important to get it below intrinsic value, and that's not just in Melbourne but all around Australia at the moment. So one way of having a margin of safety is buying an asset that, if you have to sell, if the market does change, if you get sick, if you lose your job, there'll always be a market for it. The other is to own them in the right ownership structures, and that's why, as part of every strategic plan our clients get at Metropole, they also get a structure review, the discussion of what sort of ownership structure they should buy their properties in, because different people have different requirements in your own name, in joint names, in a trust. Some people need to, it's appropriate to buy in a self-managed super fund. So you protect it by having the right property, the right ownership structures, the right finance in place, and then buying it below intrinsic value. And in my mind, that approach means that even if the market does take time to recover, your investment has that built-in buffer, reducing your overall risk, which goes right back to Warren Buffett's rule number one: protect your assets, don't risk them.
Absolutely. It's interesting, isn't it? Because we talked, and you alluded to at the start, that a lot of these rules are based on shares, but there's so many things there that kind of we can tie into property, and they're timeless investment principles. So I'm hoping everybody got a lot out of that, because I think there's, for us, we really wanted to bring this to everybody's, I guess, attention and do that. So any final thoughts from your end, Michael, before we sign off?
Well, we spoke a lot about Melbourne, but let's be clear, we have a national team that helps clients, so we don't fly in, fly out, or we're not like other buyers agents that get the local selling agent to do a FaceTime and show you what the property is. And we do not only buy in Melbourne, so we've got there's reasons why one should still buy great investment properties in the big eastern states, where maybe the Western Australia, which has done very, very well over the last couple of years, I'd start to be a little bit wary of that, and even Adelaide. So there's good opportunities in Brisbane and Sydney as well, depending upon your budget, depending upon where else you've got investments. And I believe that this market cycle started in 2023, early 23, and even though interest rates have crept up during that time, it started at the high end of Sydney, moved around Australia, not as much in Melbourne. We've had very fragmented markets, but the next phase of this cycle, if we look at the charts and show the graphs of how cycles work, the next upturn phase will happen when affordability increases as interest rates go down and as wages go up. So that will again start at the higher end of the markets. And if we think about it, this cycle really started in January, February 2023. So we're not even 2 years into it. People talk about an 18-year cycle, a 7 or 8 year cycle. Michael Matusik has done some very detailed research, and we've got his permission to show the charts that show that cycles are now sort of about 4 years. It's not because of a fixed period of time. It's a whole lot of socio-economic factors, consumer confidence. But there's probably another 2 years left in the Australian property cycle, and moving forward it will remain fragmented. So my advice is there's still opportunity. It's not too late. Think long term, be comfortable with the fundamentals. But Brett, you and I would agree that don't try and do it on your own.
No, it's just too hard, and you can't beat that level of experience. You need people who have been through these cycles, not just one or two cycles, but potentially half a dozen to kind of point these things out. And as we regularly say to each other, Michael, we identify these points in the cycle from when it happened the last time before, and we kind of get an insight as to what's going to happen next and have that expectation around when to execute.
So how does your team at Metropole, our team, but really I've stepped back and you're running the property side and the wealth strategy side, if people are interested, whether you're a beginning investor wanting to start off and not make the mistakes most make, or a seasoned investor just wanting another opinion, how can your team help, Brett?
Yeah, look, I think everybody invests in property for the same reason. I'm sure you hear all the time, Michael, it's for financial freedom, but we want to dig a layer deeper and get down deeper than that to understand, well, what kind of passive income, when, buy, what do you want to leave for the kids, all those kinds of things. And then we can actually work backwards. So we know where we are. We've got our destination. I often hear you talk about Google, where there's 3 or 4 different ways to get there, and we want to find the most efficient way. We want to incorporate buffers. We want to lower the risk. We want to diversify a portfolio. We want to set up structures. And only when we've got all that specific information and got it down to a fine art using our advanced game plan software, are we able to execute and then I guess help these people understand. I actually had a review with someone just at the moment, just on our annual reviews, Michael, and the comment he made were your buyer's agents were fantastic, but I really appreciate just, every 12 months catching up, reviewing, understanding where I am, topping up buffers, all those kinds of things. And we often talk about a plane being off course 90% of the time, and it's the kind of the pilot that brings it back on. And, having that continued support, imagine having someone by your side that you can catch up with every 6 or 12 months to, just to point you in the right direction and give you a bit of a hand. And, rather than waiting 4 or 5 years and missing an opportunity or the next step to kind of, put your portfolio forward. So that's what we do. We encompass all of that in an ongoing plan, a live document that we continually work on and help our clients achieve those longer term goals.
So if I could say, we're there for much, much more than just another buyer's agent. And even though we're a large national company and we're big enough, in my mind, to tip the scales in your favour, we're still small enough to care, because you, as a director, and the other directors of the business still see clients. I see a small group of high net worth clients I've been looking after for a period of time. But if you're interested in getting the same team that has helped, well, actually, a recent audit of the results of our clients showed that they're 7.3 times more likely than the average investor to own 6 or more properties. I guess they made the right decisions because they got the right advice. If you'd like to get the same advice, frameworks I've fine-tuned over 5 decades and we've been helping clients with for over 26 years, go to metropole.com.au and Brett and his team will help you. Thanks for your time, Brett. And clearly there's more than just Melbourne, but boy, there are some opportunities there.
Absolutely, yeah, there always is. And again, it's about sticking to the fundamentals and maybe taking some of those Warren Buffett terms on board.
Thank you.
Thanks.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you the concept that the longer it takes, the longer it will last. Let me explain to you that an average oak tree takes, 15 to 20 years before it even produces its first acorn, but then it's going to produce acorns for up to 350 years before it dies. On the other hand, I read that a cherry tree takes about 4 years or so to produce the first sweet cherries, but its longevity is much shorter. It'll produce cherries for maybe 20 years before it dies. Becoming wealthy, like the mighty red oak, takes a long time. Look, over the years, I realized that the path to becoming wealthy is a long journey. To become financially successful in residential real estate can take up to 30 years to build a sufficient asset base. Now, I know that's not what a lot of people are going to tell you on social media. Last year I was flipping hamburgers and today I'm a multi-millionaire. It doesn't work that way. I've dealt with many, many successful multi-millionaire property investors, and most of the wealthy people I come across understand how hard it is to accumulate wealth. But because of their smart mindset, they intend their wealth, the wealth they're creating during their lifetimes, to live on long after they pass away, benefiting their children, their grandchildren, their great-grandchildren, and the community. They saw their wealth as an opportunity to benefit future generations. Most of our clients at Metropole are wanting to build a legacy. Conversely, though, when you read about it, 70% of lottery winners go broke within a few years. I don't know, easy come, easy go. Because they didn't work on building their wealth over many years, their wealth really had little value to them other than spending it or giving it away to friends and family. So my message to you today is if your goal is to become wealthy and keep that wealth within your family, you must build a solid foundation forged on smart money habits, forged over many years, which you can then pass on those habits to your children as well, because it's not just what you leave your children, it's what you leave in your children. So building this sort of foundation takes a long time, but the longer it takes, the more sound the foundation will be. So my message to you, my question to you at the end of this mindset session is, which tree do you want to be? A cherry tree or the red oak tree? Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.